Hi, this is Brian Dolan with the law firm Pepper Hamilton. Every month, Pepper partner Greg Nowak hosts an investment management webinar for West LegalEdcenter. This month, Mr. Nowak was joined by Pepper partners Joan Arnold, Steve Bortnick, and Jennifer A to discuss the new tax landscape. The discussion focused on the following topics: investment proposals and Ryan's A Better Way blueprint for tax changes, the status of carry taxation, and fee waiver regulations. This podcast is a recording of that webinar. If you're interested in the PowerPoint slides used during the webinar, please visit Pepper's Insight Center at www.pepperlaw.com, where this podcast is posted. Thank you.
This is Greg Nowak from Pepper Hamilton. I'm a partner in the financial services group and a practice leader for hedge funds, and also one of the leaders of our marketplace lending practice here at Pepper. Today's focus is tax issues and emerging tax trends, and I'm very pleased to be joined by three of my partners, Joan Arnold, who's the head of our tax department at Pepper Hamilton, Steve Bortnick, and Jennifer O'Leary. So welcome all of you for coming to our program today. A quick commercial for the program that we are going to have on March 30th. We will be focusing on valuation issues of funds, general partner interest, and assets held in funds, and we'll be joined by Jim Kerr, Managing Director at Rockport Investment Partners, and Andrew Halperin, a partner at the accounting firm of Eisner Amper. So without further ado, we're going to turn to our monthly program today. A quick overview of a recent development that I think all of you should be aware of. The acting head of the SEC, Commissioner Pinaware, has revoked a number of delegated authorities to various department heads and other attorneys within the SEC, in particular on the enforcement side. And while the staff, especially the enforcement staff, has enjoyed a degree of autonomy under this delegated authority, it's now going to be necessary before actions are brought in enforcement to then be kicked upstairs to a director level and be approved. And so the expectation is that some of the enforcement actions that we've seen come out of the SEC recently may not have happened had they been reviewed by the Commission before the persons with delegated authority had undertaken them. So that's just sort of an aside, and as you know, we regularly bring securities and other issues that might be of interest to our attendees before we get to the topic at hand. But without further ado, we're going to turn to our topic. If you look to the material, slide number 2, our agenda: how might funds be impacted by various proposals to modify the tax laws? And we have 3 proposals that we're going to get into, and then we're going to talk about some recent developments that we've seen, especially as we are moving toward the preparation of tax returns for funds and their investors in the next few weeks. So, Steve, tell us about the various tax reform possibilities and what we can expect to see debated over the next few months. And for those following along, we're on slide 3.
Sure, Greg. So right now we don't have a specific tax bill that we're looking at, rather 3 possibilities. We have A Better Way, Our Vision for a Confident America, which was released by Speaker Ryan on June 24th. It's known as the Blueprint, and it really is a very general blueprint, just 35 pages that would change the code more than the 1986 Act. We have Trump proposals, which have come to us by way of policy statements on his campaign website, speeches, and tweets. And somewhat older, we have the Comprehensive Tax Reform for 2015 by Senator Hatch that was released in 2014. That one actually is several hundred pages long, but like the others, there are no specific provisions. It's more of a white paper. The Camp Bill, and I think I may have spoken with you at one of these before on some of those provisions, which was in 2014, really isn't being considered, so we won't discuss it today. Then I thought we could start talking about some of the actual provisions. These are the materials on 6 through 9, but I thought it might be a little easier to talk about each provision and what each plan would do in order rather than going through plan by plan.
But before we get there, let's talk about the procedural hurdle to any effective tax legislation. Slides 4 and 5, how can this happen? We all know that the Republicans have a majority in the House, and they have 52 seats in the Senate, assuming all of them go along with one or the other proposal that might be out there. However, the rules of the Senate for unlimited debate allow for filibuster, and in order to get a cloitre, you usually need 60 votes of the Senate to cut off debate. So where are they going to get those 8 Democratic votes if it turns out that the Democrats filibuster and oppose any such legislation?
What we're hearing now, and Joan will probably want to chime in, is that they're not actually going to look for those Democratic votes. Rather, what they're going to do is use the procedure of a budget reconciliation. And if they go that way, they can avoid the filibuster and pass it based on a 51-vote majority.
But isn't budget reconciliation limited? You can't.
Yeah, budget reconciliation is a political procedure that was adopted in about 1974 as a means of getting budgets through when we were in exactly this situation. Because you only need 51 votes to pass it in the Senate. Without budget reconciliation, the bill never actually gets to the floor because you do the filibuster, and if you filibuster, the bill dies because it times out. So what happens is that the procedure that was put in place says, okay, if you invoke the procedures of budget reconciliation, there cannot be filibusters. It's just a procedural rule in the Senate. So what happens is that the bills go in, and if they get through and they meet the requirements of budget reconciliation, once they get to the Senate floor, they only need 51 Republicans to pass it. They can ignore the Democrats. Mitch McConnell has gone on record saying we intend to pass our bills without worrying about the Democrats. And the only way they can do that is to go through budget reconciliation or the nuclear option where they change the rules and say you don't need 60. But people aren't thinking that's going to happen. So what are the...
Well, hold on a second here. The Constitution specifies that each House can set its own procedural rules, right? So the Senate has set a rule by a 51-vote margin that you will allow unlimited debate, namely the filibuster, and the only way you can vote cloitre is if you get 60 votes. But the nuclear option is the Senate votes 51 to 49 to eliminate filibuster?
Yes. I mean, that's what the nuclear...
They don't need a 60-vote majority to eliminate the filibuster.
No, but that's not... I mean, when people say that, they then stop talking, and they say, okay, but that's not what we intend to do. But I think they do intend to use budget reconciliation. Now, the rules for budget reconciliation are very strict, and the way it works is that you first have to have a budget resolution that is adopted by both the House and the Senate, and they have to be identical. And they can only include provisions that have a budgetary impact. So, for example, if you wanted to pass a bill that would repeal ACA, and you had to do it through budget reconciliation, you would have a problem. Because you could repeal, for example, the medical device tax through budget reconciliation because it has a budgetary impact. Can you repeal the requirement that everyone have insurance? That doesn't have a budgetary impact. So that piece you wouldn't be able to put into a bill that would go through budget reconciliation. You can only do something that has a budgetary impact. One of the things that's most interesting about the use of budget reconciliation is what happens if the budget that is passed has a deficit that goes beyond 10 years. And you might remember that that's what happened when George Bush lowered the individual tax rates when he was in office. He had to use budget rec to get it through. And since he had to use budget reconciliation to get it through, at the end of the 10 years, which was in President Obama's tenure, the rules sunset. Now, when the Bush rules sunset, what it meant was we went back to the tax rates that we had prior to the time that he lowered the tax rates. That's not so hard. You just change tax rates. If they use budget reconciliation to get through, for example, the blueprint, we would have a massive change to the income tax system of the United States.
For 10 years.
For 10 years.
And then it sunsets.
And then it sunsets, and then you go back to exactly where it was before budget reconciliation is passed. So how one handles this in financial reporting, in planning, is completely unknown. Now,
as a securities lawyer, I could tell you cure everything with disclosure, right?
I guess so. but the Democrats and the Republicans think that even if budget reconciliation is passed, the 10-year issue is not meaningful because each of them assumes that they will recover 60% votes in the Senate, and then they'll simply either confirm what was done through budget reconciliation if the Republicans get it, or if the Democrats get it, they'll just repeal it. So people the politicians, those of us who do planning for taxpayers are worried about it, but the politicians think that that's not a real issue to worry about. So we follow the bouncing ball of budget reconciliation to see how it's going to come out.
I just wanted to chime in. I know you're going to talk about some of the international provisions. All of the other provisions aside, this is going to change the way people do business. It's going to change our relationships with our treaty partners and our trading partners.
So this is not
at the end of 10 years, it's going to go back is stunning to me.
Yeah. So it's not just a George W. Bush, let's lower the tax rates.
No, and that's what budget rec has generally been used for.
Right.
Changing rates, changing small things. It hasn't been used to say we're going from an income tax to a VAT. So.
All right. Well, nobody's proposing that.
Of course we are. That's exactly what budget rec is. That's exactly what the blueprint does.
Okay. So.
Well, we'll save that. So let me, I did just want to chime in a little bit about timing first. I know some people are hoping that things are going to happen this year. I was just at the Association for Corporate Growth Policy Summit, and anything happening this year seems unlikely, but next year seems much more likely. But that said, so let's jump into some of the changes, and these are on pages 6 to 9, but I'll cover it in a little different format. First, easy top individual rate. The blueprint and the Trump plans would reduce those down to a top rate of 33%. The Hatch plan doesn't indicate what the top rate would be, but it would be lower than the current 39.6.
Can we just talk about the Hatch plan just for a minute because it's so different than the other two?
Of course.
And the Hatch plan is something that the United States has looked at over the last 20 years, and we never pulled the trigger to do it. And it was based on the way many of the European jurisdictions used to handle their corporate and their individual tax. And he has what's called an integrated system, where a corporation would make money, and it would have a 35% tax rate, but then it would get a deduction to the extent it paid a dividend to its shareholders, so that the income it's earned is only taxed once as opposed to twice, which is what we have in our current system. And I quite frankly thought that integration proposal was fairly moribund, because Europe has gone far away from it. Nobody uses it anymore in Europe. They found it to be ineffective. And then I was surprised to hear that this week the Senate Finance Committee Chief Tax Counsel came out and said that the news of the corporate integration's death is greatly exaggerated, and that the Senate still thinks it has a very viable role in tax reform. He acknowledges that the full details of the plan are lacking, but it would reportedly use a dividend paid deduction, as I was describing. However, the plan may also include a non-refundable withholding tax of 35% on both interest payments and dividends. So the reason that they're not talking, as you noted, Steve, about the maximum individual rate is that the Hatch plan is all about the corporate tax. And they haven't yet said anything about the individuals. That's kind of like that's coming.
Right. Yeah, so there is an analog right now that exists for a dividends paid deduction. Personal holding companies and registered investment companies and REITs, they operate as corporations or taxed as C Corps, but then they have the overlay of Subchapter M that gives them the dividends paid deduction.
Right.
So that does work. It's been working since 1940.
But in a very specialized industry.
But in a very specialized industry, right. That's right. So really what we're seeing here is corporations being nudged to use some of that massive amount of capital that's on their balance sheets in ways that they haven't decided to use it, right? Apple has more cash on its balance sheet than most countries, except maybe the top 8 in the G12, right? So Apple could buy Greece and not even break a sweat. But when you look at all that cash sitting on their balance sheet that they're not using for productive purposes, this would be a way to unlock some of that instead of enforcing the accumulated earnings tax, for example. And so, does this make sense? Maybe, maybe not. How big, however, is the tax loss of an integration plan like this?
Well, when Europe took it away, when Europe had it, they did not have a significant VAT. The way that Europe was able to undo integration and to make the systems work was to put in a very significant value-added tax.
To make it revenue neutral?
To be able to fund their countries, yeah.
Okay.
Yeah.
But in the United States, the corporate tax pales in significance to the individual income tax, right?
In terms of the collection?
Yeah, in terms of dollars collected.
Well, yes, because of the decline in the use of the C corporation and the increase in businesses being in flow-through treatment, which means that it's all through individual tax. We collect more in the individual tax than we collect through the corporate tax.
And those of you who've attended this program before, know that we're always bemoaning the fact that there are fewer and fewer publicly traded companies out there to invest in, which makes the job of hedge fund managers and other investment managers that much more difficult. But, of course, in order to be a publicly traded company and listed on an exchange, you end up being a C Corp, and you have to pay tax unless you're one of the very narrow master limited partnerships in the energy sector, which we're not talking about here in particular. But focusing on C Corps, that would mean that one of the biggest barriers to smaller companies being listed, assuming I take care of the security stuff, but one of the biggest barriers gets lifted because now we no longer have an entity-level tax?
Well, you only now no longer have an entity-level tax so long as you distribute your proceeds, your earnings.
So if I distribute them and they reinvest,
but the shareholder then has
ends up having to pay the tax.
Right.
So very similar to what you'd end up with the registered investment company or the REITs.
Right. I'm sorry, Steve. We jumped right in on your conversation.
Not at all. Not at all. It does make sense to at least mention, since we're talking about the integration, the Ryan plan would do a semi-integration in that it would provide for a 50% deduction against interest, dividends, and capital gains, and that would effectively ameliorate some of the double tax. And the Trump plan would just stick with our current 20% tax on those rates.
But I thought the blueprint had an elimination of the net business interest expense. What's the theory behind no longer allowing a corporation to deduct interest?
So that would also be for individuals, all business income. It's a trade-off for what they would like to do to encourage investment in capital assets, which is an immediate write-off or immediate depreciation of capital assets other than land. And then the way that would be paid for is getting rid of the interest deduction. That also helps because he has not just a pure tax policy, but he doesn't want to encourage the use of debt and feels that by having an interest deduction, that encourages the use of debt. So we would get both of those, the immediate deduction, the elimination of the interest. The Trump plan, by the way, has the same concept of immediate depreciation and the same concept of no interest deduction, but only if you elect the immediate depreciation. So under the Trump plan, it's elective. Under the Ryan plan, they go together, but you're stuck with it, which means there will be winners and there will be losers. Now,
if I'm remembering correctly, Joan, you and I were around at the time, but I think these two were still probably not. The Economic Recovery Tax Act of the early 1980s, when Ronald Reagan was elected, basically gave us investment tax credit, accelerated depreciation deductions, and expensing. And the economic analysis that was done after that was was that the combination of the accelerated depreciation, the expensing, and the investment tax credit was actually better than straight expensing. And as
better for whom?
Better for not the country.
Okay.
But better for businesses who are using, depreciable property. And it was so lucrative that we immediately had the TEFRA, DEFRA, and the whole series of tax acts beginning in 1982 to try to unwind some of those.
Right.
So are we looking at the exact same waterfall happening again, where we have this massive, stimulus to the economy, Keynesian stimulus, resulting in, the barn door being closed after the tax dollars have already left?
Well, one of the trade-offs here, though, is how you're going to fund it. Because in the acts that you're talking about, you can go out and borrow and make those investments. If you go out and borrow under this bill, you get no interest deduction.
So I raise equity investment. I do a Series A or B or C round, or pipes as opposed to.
But if you're going to do that, you're going to have to give people a return, and that return is not going to be deductible. So it's not going to be cheap to raise that equity. So I think that we'd have to see how it floats out, but I think it's a challenge.
So there would, under all of these plans, be a reduction in the corporate rate. Under the Ryan plan, flat 20%. Under Trump, a flat 15%. And again, Hatch doesn't specifically say, but he quotes a statistic that seems to indicate that he likes 25%.
For no particular reason, just sort of likes it. Nice round number.
I said that too cavalierly. Basically, he says if you get rid of all the business deductions, then you can afford a corporate rate of 25%. So he didn't say that was his plan, but since he threw that in. So one thing we talked about individual, we talked about corporate. Now I want to just talk about businesses through pass-throughs, since we were talking about that. The Ryan plan would allow income that you earn through a sole proprietorship or through a partnership, LLC, S corporation, to be taxed at a maximum rate of 25% instead of the top individual rate of 33%. But he understood that meant that everyone would then just start not paying themselves salaries and taking this income as business income. There were articles about all of the employees who would set up corporations to provide services to their own employers. You have to pay.
Yeah, but 280G would stop that, right? I mean that was a technique we used to have around a long time.
You're talking.
That requires a change in control.
Personal holding company.
No, but that requires a change in control. 280G.
Okay, maybe I'm using the wrong reference. There is a prohibition on using personal holding companies.
Personal service companies,
right, to obtain a benefit that you can't obtain directly. And that's been around since 1986.
I don't think we have to go that far into the technical details. I think that what they said when this came out was you can't screw around to get this pass-through rate. So what they were intending, Steve and I form an LLC, and we perform plumbing services. And that plumbing business makes $10 million because we've got lots of plumbers and they're all employed and we're doing great stuff. And Steve and I pay ourselves compensation of $500,000 each. That leaves $9 million of taxable income in the LLC from the plumbing business. Steve and I would pay 33% tax on our reasonable comp, and then the remaining $9 million would flow through to us in a pass-through manner, and we would be taxed at 25%. That is intended to support the growth of small businesses where there is an actual business, but it's not intended, Greg, although you might like this result, for you and I to be able to say, gee, the income that we get from Pepper, which is a partnership, some of that should be taxed at 25%. I can't point to anything specifically, but I am really sure that Ryan did not intend that you and I can convert some of our income from our law partnership to 25% money.
But we're small. Sure, we'll find a way.
I'm sure we'll find a way.
But I want to just quickly mention Trump and Ryan would get rid of the 3.8% Medicare tax, the AMT. Trump is...
Although, they say they'll get rid of the AMT,
okay,
but the NOLs, which can now be carried forward indefinitely or could be carried forward indefinitely, can only offset 90% of your income. So if you offset 90% of your income, you have to pay tax on 10%. At a tax rate of 20, it's identical to the AMT. So
right, but that's
we're not calling it that.
But I think in terms of simplification, I think as a first-year associate, because I was working in New York, paying New York State and New York City taxes, I was in an AMT position.
Right.
That was my only deduction.
Yeah, I was just thinking about it from the corporation.
Right, exactly. The big thing, and I'd like to just now fully turn it over to Joan, is Ryan's plan to move to a territorial tax system.
Yeah. And it's a territorial tax system and then a border-adjusted tax system. And this is the stuff that really is capturing the heart and soul of American taxpayers because it's such a huge difference. Right now, a U.S. corporation that has foreign operations through branches includes that income in its U.S. taxable income on a current basis, even if it doesn't bring cash back, and it is subject to the 35% corporate level tax.
Now, hold on a second. That assumes that those entities abroad, that it's not an entity abroad.
I said through branches.
Okay, through branches.
Right.
Okay. On to slide 10, though, for those of you following.
Right. And I haven't gotten quite there yet. But similarly, if a U.S. corporation has a foreign subsidiary that operates outside the U.S. and earns income outside the U.S. and pays foreign taxes outside the U.S., when it pays a dividend back to its U.S. parent, that dividend is includable in taxable income of the U.S. parent and runs through the 35% tax rate. It's what we call the worldwide taxation model that we have had since the code was put in place. Ryan would move to what most of the rest of the world has. Ryan would move to a territorial system, also called sometimes a water's edge exception system, so that if the income is earned outside the United States, it's not subject to tax in the United States, whether it's earned through a subsidiary or whether it's earned through a branch. So to the extent you have income outside the U.S., we won't tax it. The difference is huge because right now there is $2.5 trillion of offshore earnings of U.S. companies, so they've been earned in foreign subsidiaries, that have not been subject to U.S. tax because people have said, I'll just keep my money in my foreign subsidiaries and not include it in my U.S. tax base because, gee, I've managed to put it in Ireland where I have an 8% tax rate. I'll use the money there. If I bring it back to the U.S., I'm going to have to pay the delta between 35 and 8, which gives me much less money to invest and keep in my company.
But doesn't a water's edge tax exacerbate that? Doesn't it give you a greater incentive to keep money offshore?
What it's supposed to do is drive your decisions as to where to put your offshore operations based on whatever the jurisdiction is that you have to be in. So it says, it's the principle of capital export neutrality, saying we won't tax the offshore earnings. You figure out where your company should earn, and we'll keep it offshore.
Yeah. Well, to quote Ross Perot, you'll hear this huge sucking sound as every U.S. company moves its business operations offshore.
Well, I mean, we already have that, but now we've got the $2.5 trillion of cash that can't be used in the U.S. So,
that's not true. There was a Wall Street Journal study that said virtually all that money is actually invested in U.S. banks.
Yes, 90% of it is. But if Apple wants to bring back its cash,
as Apple,
and they want the cash to come back in order to fund a share buyback, they're going to have to pay the delta. They're going to have to pay the U.S. tax that they haven't paid before.
Why wouldn't they borrow it?
Well, because if you borrow, what they did is they went out and borrowed it, but you can't have that borrowing supported by the offshore assets. Otherwise, there's a deemed inclusion equal to the amount of the... So Apple couldn't, for example, pledge the stock of its Irish subsidiary, and I don't know if it's in Ireland for Apple, but they couldn't pledge the stock of their foreign subsidiary that has the assets in order to support a U.S. borrowing, or you have a deemed income inclusion in the U.S. So Apple really doesn't have access to that cash for corporate tax purposes, for U.S. purposes. Once you get a territorial system, since we're no longer taxing the income that's offshore, that cash can come back onshore with no tax consequences. Now, there are many economists who say that this is a terrible decision for the United States. And there are many who would say the worldwide taxation is exactly the way we should keep it, and we should make none of these changes.
I will go the other way and create barriers to companies doing inversion transactions or otherwise moving their business operations offshore.
But the only reason you have to do that is because of our current system, which says we're going to tax everything at some point in time. So if we don't do that, then people don't need to invert. So you leave your U.S. business here, you grow it here to the extent it makes sense to grow it here, and you grow it offshore to the extent it makes sense to grow it offshore. The other thing that you'll see, and we'll talk a little bit more about territoriality in a minute, actually, let's just go through the examples, and we'll talk about it as we go, because I know that we're starting to get a little time-pressed. So if you go to slide 12, you'll see, and all of these slides, folks, you'll see that the title says, what does this mean, maybe? The reason the maybe is in there is, as Steve mentioned, the blueprint, which is the one that people are focusing on the most, is 35 pages. The last page is all footnotes or endnotes. The first time the blueprint talks about tax is on page 27. So we are talking roughly about 6 to 7 pages of prose that would completely overhaul the tax system. So anything we say about what we think will occur is subject to major revision as they actually put together some legislation, which they are working on now. But 12 talks about what territoriality does. U.S. company owns a CFC, a controlled foreign corporation. The controlled foreign corporation has earnings of 100. It pays foreign taxes of 20. There's a dividend of 80 that's paid up to the U.S. company, and there's a withholding tax that comes out. Under current rules, U.S.
Withholding tax goes to whom?
The jurisdiction of the CFC.
So that's not a U.S. tax.
No, it's not a U.S. tax.
That's important people understand.
Right. So under today's rules, the U.S. company would have included income of 100, and it would have taken a foreign tax credit of 30, and it would have owed the U.S. government $5. Under a territoriality system, the U.S. company would have a dividend received deduction of 90, the net amount that it was. That should actually be 80, sorry. Just found that. And there'd be no foreign tax credit for the 10 or the 20, because U.S. Co. would have no income. We do have some technical questions as to whether those foreign taxes could somehow be used against other income, but in the 6 pages of prose, they didn't address that issue. The other part of the other part of the territoriality system that is important is that, remember that we said that we have $2.5 trillion of earnings that are offshore currently that haven't been subject to U.S. tax. If, in fact, we go to a territorial system, we need to clean up the past practices. So what we would see in the blueprint is that to the extent a company has, say, $1 billion offshore that hasn't previously been taxed, it will be currently includable in the U.S. tax base even if it's not repatriated. So, for example, if your U.S. company had a foreign subsidiary and the foreign subsidiary had been investing in its own plant and equipment and it had some operating cash on its balance sheet, under the Ryan proposal, you would find that income has to be included in the U.S. tax base to the extent it's in cash, which is where most of it is. It would be taxed at 8.75%. To the extent it's invested in plant and equipment, for example, it would be taxed at 3.5%. Note, there is no requirement for the cash or any of the assets to come back into the states before this tax would be imposed. So when you're looking at a portfolio company that's got a lot of cash offshore and you're trying to figure out the valuation of that portfolio company, and you're looking at a lot of the earnings that have been kept offshore, that U.S. company may have a very large tax liability to deal with if the Ryan bill is passed.
And is that tax due immediately?
8 years. You get to pay it over 8 years. So it's a challenging amount. That's different than the Trump proposal, which would say that to the extent a foreign subsidiary repatriates its earnings, prior earnings, will tax them at 10%. That's a choice, because if you choose to leave the earnings offshore, you don't pay any tax. It would be like the old one-time exception for taxing offshore earnings. The Ryan bill is not elective. If the Ryan bill passes, the cost of cleaning things up to go to a territorial system is that you have to include all of your prior earnings into the United States.
So we have an immediate bump in receipts as that $2.7 trillion comes back.
Well, see, it doesn't have to come back. You'd have
Even
it
under the Ryan bill, it doesn't have to come back.
No, under the Ryan bill, it doesn't have to come back. It just gets taxed.
It just gets taxed. So there would be an immediate tax bump.
Well, you pay it over 8 years.
Okay.
But you would. Okay. So what is the other major part of the blueprint? The other major part is what's called border adjustability. And let me step back a minute and talk about how the rest of the world imposes taxation. Let's assume that you've got someone who has a component part. They sell it to a manufacturer. The manufacturer sells it to a wholesaler. The wholesaler sells it to a distributor. The distributor sells it to a retailer. The retailer sells it to the customer. All along the way, there is value added to that product, and there's 5 or 6 sales in there. And under what is a standard import VAT structure, value-added tax structure, at the end of the day, the customer would pay the VAT, the value-added tax, on the product, and then all of the component parts along the way, the manufacturer, the wholesaler, the retailer, they would get a credit against the VAT that they had paid. So at the end of the day, the VAT is paid once at the end of the consumption process by the ultimate consumer. When we put the U.S. into the mix, here's what happens. You have the people who are manufacturing offshore, and they are paying the VAT as they go along. But then when the product is exported to the United States, the United States doesn't have a value-added tax. The people who did all the manufacturing, because they exported the goods, get all of their value-added tax back. And then the good is sold in the United States, and VAT is never collected. And it's never collected so that there's a benefit for importers to import into the United States. The good can be sold cheaper. What Ryan's plan says is that we have to adjust our taxes at the border, but that in political circles is a 4-letter word, even though it's only 3 letters. There is simply no political will to impose a value-added tax. Treasury tried about 6 years ago. They brought in some people who were highly competent in the VAT systems to begin to educate Congress and to begin to educate Americans on why we need a VAT. The people who were doing it were pulled from office about 6 months after they started. So the blueprint goes to great pains to say this is not a VAT. But look at what it does. Look at slide 13. Slide 13 tells us what could be under the blueprint. And the U.S. retailer buys U.S.-made inventory and sells it for $60 and sells it for $100. Under today's system, there would be 19.5 of net income. You take in income of $100, cost of goods sold of $60. You'd have SG&A of $10. The tax would be at 35%. The same transaction under the blueprint looks great because you've lowered the tax rate to 20. So under the blueprint, you take the deduction for the cost of goods sold, the SG&A, your taxes are only 6, your net income is 24. So when people started to look at the blueprint, businesses thought, this is great. This is like the best thing in the world for me. until they started to understand what the blueprint meant by border adjustability. So look at page 14, slide 14. If the U.S. company imports its product and it sells the product, so it's the exact same transaction, under the blueprint, there is no deduction for cost of goods sold. So if you think about Walmart, or you think about Target, or dollar stores.
Or anybody who's importing goods.
Anybody who's importing goods. You're not going to get your cost of goods sold. So while your tax rate goes down to 20, because you lose your cost of goods sold for anything that's imported, your net income goes to 12. I have a little bullet point there that says, what happens if the margin is 10 and not 30? Well, you're now underwater because you can't take the deduction, you still owe the tax, and you are now truly underwater.
So I won't import anymore. I'll buy goods that are made in America so I can get my cost of goods sold.
Except one, it's almost impossible to buy what we import in stores like Walmart and Target.
Right.
Because nobody's manufacturing it in the United States. Two, the cost is going to be incrementally expensive if somebody actually sets up the product line in the United States. And you can't simply change business on a dime like that. They can't do it. So now we start out with retailers. What about manufacturers? We have quite a number of clients, as is very common, where you've got a U.S. company that has set up manufacturing outside the United States. So, for example, you might have a maquiladora in Mexico, which was set up for the purpose not of taxes, but for having great labor at reasonable prices. If you do all of your manufacturing through a maquiladora and you buy the product back, you're not going to get a deduction for that. So in this case, my manufacturer is not going to get a deduction for the goods that they're bringing back from Mexico. This has people quite up in arms. I mean, people initially thought it was just retailers. Any global company, there's a reason that people don't manufacture in the United States anymore. It was more cost-effective to manufacture outside. The one good thing is if you export your goods, you don't include the income at all, which is very helpful. But then you look at slide 17, and this is not just the importation of goods, it's also the importation of services. So if I have a U.S. company that has an Indian subsidiary that creates the R&D for my company, and I pay that Indian subsidiary, as I have to do under transfer pricing rules, I'm not going to get a deduction for that anymore. So the reduction of the 20% of the tax to 20% is not going to offset the fact that I'm not going to get that deduction.
So with full recognition that we're dealing with 7 pages of white paper and not necessarily the technical analysis, what you're telling us is, this is a public service. People need to understand that a border adjustments tax is not necessarily going to lower their tax bill. If anything, it will substantially increase their tax bill as well as their costs.
Right. And the important thing is to recognize that this is, other than the fact that you get to deduct your SG&A, this is a VAT. It's a consumption tax. You're buying it, you have to pay the consumption tax. Ryan explicitly says it's not a VAT, it's not a consumption tax. If it's not, it's probably illegal under the WTO because the WTO says that the only type of a tax that can benefit exports is a VAT-type tax. If we think this is an income tax, it's in direct violation of the WTO. So we'll see where that goes.
Well, just like AGA wasn't a tax.
Yeah.
It was upheld because it was a tax.
No, the Supreme Court held that it was, in fact, a tax, right?
Exactly.
It looks like a duck, acts like a duck, walks like a duck, it's a duck.
So, Jennifer, what do you think the funds can expect?
So one of the big effects that's expected of this border adjustability tax, and frankly the only way that it wouldn't really hurt U.S. consumers, would be if the dollar gets stronger. And economists are saying that that's at least some economists, many, are saying that's a likely effect. So suddenly...
So wait a minute, a stronger dollar means exports are that much more difficult because our goods become that much more expensive abroad.
Yes, but the driving of imports, the fact that you are suddenly making things in the U.S. and people want to buy into, so that.
But you have a huge lag time between.
Well, that's a question.
That's a question.
It's a huge question. Like they're saying, does it take a year, 2 years, 3 years? Does it ever adjust completely? Obviously, the U.S. dollar, there are lots of other currencies in the world. How much does the U.S. dollar adjust under each one, against each one? So the fact that this is sort of a theory that this is going to happen, and I do think a lot of the economists, at least the commentary I've read, seems to think that it is going to happen. But by how much, how quickly? So there would be a lag time, which would perhaps give people time to adjust, but of course you don't know precisely what you're adjusting to. And so, for example, we have a stronger dollar. You've got sovereigns and other borrowers who borrow in dollars. That's not their home currency. So if you've got a fund that's investing in foreign debt, emerging markets or sovereign debt, and suddenly the dollar is getting stronger, it might make it a lot harder for them to pay back that debt. So you might have a debt.
It wipes out an enormous amount of value.
Well, and that's the second one. That was my other point. You, as a U.S. person, are investing abroad, a lot of your value is gone.
Well, but you're also going to wipe out a lot of value in American companies, too. The Trump trade in reverse, because you've just made it that much more difficult to generate those sky-high valuations. The P&Es are going to go through the roof. The earnings are going to drop.
There are a lot of different, it's absolutely true. There are a lot of different effects, and that's what some of the commentators are saying. That hasn't really been addressed completely yet. You're wiping out a lot of value by doing this. So that's one thing that the strengthening dollar, assuming that it happens, has a lot of effects.
All right, so we have about 10 minutes. I do want to get to the technical grab bag, though, because there's a lot of great information for our people who are tax professionals or, tax wannabes on the phone. So let's talk about the W-8 Ben E.
So one of the real important things to bear in mind with the W-8 Ben E is that you can only rely on it if under the limitation of benefits provisions, which we've produced down here, that they only check under B one box. Like if they check all of them or every other or, whatever combination someone looking at this thinks might apply to them, you can't rely on that.
So what's the effect if I can't rely as a fund on a W-8 Ben E?
So you're not in compliance.
You have to withhold.
I have to withhold. That's the important message.
You have to withhold.
So a W-8 Ben is designed to say that the beneficiary is entitled to rely on a treaty or other exemption from withholding tax.
Or perhaps a lower rate. But yes.
But does that also assume that I have a trade or business inside the partnership, the fund, in order to withhold, or assuming the interest is always exempt because it's going to be portfolio interest?
Well, if you've got portfolio interest, then,
Yeah, but you still have...
You don't have a proof that they're foreign.
But I still have FATCA.
That's the problem, and you don't have a reliable...
But FATCA fully in force when? Now?
Yeah.
Okay.
On FDAP income, like interest and dividends?
Yes.
Absolutely.
So this is not an easy form to fill out. I mean, I've gone through it with clients. I've filled it out for clients. It's not an easy form to fill out, and you can't rely on it if you get it.
Okay, so Steve, during our prep session, you were talking about circumstances where managers of fund complexes have attempted to give you a W-8 Ben E filled out for the name of the manager, even though the manager hasn't made a commingled investment. It's the underlying funds that have made the investment.
Right, so we were talking about when can you accept a W-8. I was looking on behalf of a fund that received one indicating that the payee was exempt because it was an investment manager. When I saw the amount being invested and had a conversation with the general counsel, it was clear that the investment was being made by investors advised by the person providing that. I asked for the W-8s for all the investors, and they refused because they didn't want to provide that information, which is exactly what FATCA was intended to get at.
Right. So those of you listening, there's no cheat here. You can't say, oh, well, it's the manager who's going to fill this out. It actually is the fund that has to provide this information in each case.
That's right. On both sides, I mean, when we're representing a fund that is receiving this from an investor, if the fund fails to withhold, they're personally liable. It's not as...
The fund is liable or the manager's liable?
Really, but whoever makes the decision, the fund, the general partner, and whoever makes the decision on behalf of the general partner. The idea is to really collect this. You can't just say, well, they gave me a form, it's their tax.
Yeah, and that's a very important point. There is no plausible deniability in these forms. You have a job to do, and that is to make sure the form is understandable and at least reliable. And if you have, as Jennifer said, multiple boxes that have been checked, it's not reliable, and you have to go to the next step, or withhold.
Yeah.
And that's always the answer, to withhold. And if you're in a defensive posture as the manager of a fund with foreign investors, you're 100% liable if it turns out, because your investors are not going to, your other investors are not going to allow you as the manager to deduct this tax, because you made the decision, not the underlying investors.
Right.
So that's a very important point. Okay, the enhanced QI LOB procedures. What are we talking about, Jen?
There's one interesting point here. A QI is the qualified intermediary that takes over the withholding responsibilities. And the interesting part is that they now have to get certifications from all of the people that they are dealing with as to the use of a limitation of benefits article under a tax treaty. The interesting thing is that they cannot rely on the LOB claim if they have actual knowledge or reason to know if the claim is incorrect. What does it mean to have reason to know? Well, if somebody hands me a W-8-B-E-N-E claiming the limit, a U.S. person, a foreign person, claiming that's a Singapore resident, claiming the benefits of the U.S.-Singapore tax treaty, I can't accept that. We don't have a tax treaty with Singapore. So if you get a W-8-B-E-N from a country with whom we do not have a tax treaty, you can't accept it even if it looks right on its face. So you have to be a little careful about that.
So you can't just expect that if they say there's a treaty, it exists.
You have to know.
And find that treaty.
Right.
So just draw me a picture here. We're talking about a U.S. fund with a foreign investor.
Right.
They have given us a form that says they're exempt because of a treaty, and our first step is, okay, facially, is it complete? Are there contradictions, as Jennifer pointed out?
Right.
And then, do they claim something that you just know?
And you can't say, I didn't know we don't have a treaty with Singapore. As a withholding agent, you are obligated to know whether or not that is a valid claim.
And who would be the qualified intermediary in that structure that we just described with the U.S. fund and the foreign investor?
That's not even a QI. That's straight withholding.
So draw me a picture where we have a QI.
You might have payments going from the fund to Deutsche Bank. And Deutsche Bank is going to send the investments out to its investors. But
Deutsche Bank is acting as the paying agent or custodian?
It's acting as a qualified intermediary. Yes, it's acting as the paying agent.
Okay.
So it's not holding investments as investments in Deutsche Bank. It's holding investments from third parties in your fund as a paying agent.
As a paying agent.
That's a QI. So when the fund goes to make a payment to that entity, since it's paying it to a QI, it doesn't have to look up to find who the QI is going to make the payments to. The QI then has to make the decision as to look up to figure out who the investors are and figure out whether withholding will apply. So in that case, Deutsche would have been your QI.
But wouldn't Deutsche Bank or whoever would be the QI in that circumstance have in its agreement with you, its paying agent agreement, that they will withhold unless they're 100% sure? Because they want to protect themselves.
Oh, yeah. I mean, they would. But it's just what's instructive about this was what it means to have reason to know that you can't use a treaty. So in your direct investment, when you've got your U.S. fund that's making a payment to a foreign investor, they have to know whether or not there's a treaty that's applicable. They can't just rely on the claim under the W-8-B-E-N-E.
Okay. So take us to the next slide, 20.
Okay. We all know what FATCA did. FATCA says, so if you look at the picture there, you've got country A bank that has a U.S. investor. The U.S. and the country A has a Model 1 IGA with the U.S. This is all about where the information gets reported. Under the IGA, country A is going to have to tell the U.S. about the existence of that U.S. investor. The question is, when are they going to have to tell them, and how are they going to have to tell them?
IGA, by the way, is intergovernmental agreement, for those of you who may not know.
Right, if you're not a FATCA maven.
There's like 3 people like that in the country, Joe.
Yeah.
Come on.
So the whole goal here is to leverage off of the information that's collected in country A so that it gets to the IRS. And then whether the IRS should send it to country B because there was a country B investor in that country A bank. And there are 2 different ways that information is exchanged. One is called an exchange of information upon request, and the other is an automatic exchange of information. The automatic exchange of information requires a common reporting standard. The use of W-8 and W-9s is not sufficient. You have to use self-certification procedures, and while this only applies to foreign financial institutions, you might find that your clients are stuck with changing their certifications because if we go to a common reporting standard in the U.S., because people have gone to a common reporting standard outside the U.S., you might find that somebody's going to say W-8, W-9 isn't enough.
Okay, we have about 2 minutes left, and we also saw a couple of comments that people were having difficulty with sound. We don't believe that that's a technical difficulty on our end, so we do apologize. But there will be an audio recording of this available generally through Thomson Reuters, so I suggest you talk to the Thomson Reuters rep, and hopefully you'll be able to get over that connection difficulty. Quick wrap-up, Jennifer, what's going on with the new partnership examination regimen? And it's not effective for this year. It's effective after 2017,
It is
correct?
effective for after 2017, and it very radically changes the way that partnerships are audited, so that the default rule beginning after 2017 will be that partnerships pay the tax. If there's an audit and there's an adjustment upon audit, partnerships are supposed to pay the tax.
So
However,
if we do nothing, if partnerships or LLCs do nothing, LLCs treated as partnerships, what's the default rule? What happens?
So I think it would depend on how their agreement reads, but assuming there's nothing in the agreement, and they got audited.
Stuff from TEFRA, from
right. So the tax matters partner, now you've got a partnership representative rather than a tax matters partner. The partnership representative does not have to be an actual partner, tax partner. But if we do nothing, then the partnership, if there was an adjustment, would in theory have to pay it and presumably get that paid to them by their partners or treated as a withholding tax, for example, that they paid on behalf of their partners. The other option for the fund, or for the partnership, I should say, would be to elect to pass that tax out to its partners by means of what is essentially an amended K-1, although the law calls them statements.
But it's a K-1 going back to when the tax would have been incurred.
That's right.
As opposed to
being paid by the current partners.
Investors. So looking at it from the point of view of, what people are most familiar with, the mutual fund rules, a mutual fund would pay the tax currently, and the current investors would see a reduction in their NAV.
And so that would be more like what this law intends to happen, that it happen at the partnership level, because there are disadvantages to doing the amended K-1 procedure, because the partners would then pay a higher rate of interest on those taxes. The other disadvantage, which we don't know yet if it's going to be true, is it's not clear that the IRS is going to allow tiered partnership structures to pass those amended K-1s through multiple tiers.
So it may end up with the entity level tax no matter what.
It may. We don't yet have, although rules were issued at the end of, proposed rules were issued at the end of January. They were caught up in the freeze on regulations. So we don't really know what's going to happen with respect to this. We don't know when we're going to get rules, hopefully before the law goes into effect, but we really don't know at this point if that's going to happen.
But should funds be modifying their partnership agreements?
Funds should be modifying their partnership agreements. We've been putting in fairly general, it depends, of course, on the fund and what's going on, but we've been putting in fairly general language that would cover them, in essence, generally treating it as a withholding tax and giving the fund or the GP the option to perhaps pass it out to the partners. In a smaller partnership, there would be other options available, because in theory you could have all your partners amend their returns.
But I would assume in a private equity or venture capital fund where you don't really have significant movements of partners in or out of the entity,
then it makes a lot more sense.
Let's leave it alone.
It
right?
makes a lot more sense to pay it at the partnership level in that situation where you don't have a lot of movement in and out.
Whereas
although there's always the issue of having the cash.
Well, true.
But having the cash is always an issue. But that's
when you make a call.
Yes.
But
when you have the ability to do so, you're not past your.
So there's a lot of features that have to tie in. The ability to call capital contributions, or
in a typical withholding procedure, you might have an ability to pay it and force your partners to pay it back. So if you treat it in that manner, that's one way to deal with the cash without necessarily having to go through the call procedure too. So there's different things that can be done. We may have more options once we see the regs that will go into place, but at this point, you can put general language that covers.
Okay, well, thank you very much for your attention. We're a few minutes over. Hopefully you all stayed with us, and hope to see you next month when we will be discussing valuation of investments held by investment partnerships and valuation of carried interest and other interests in the partnership. This is Greg Nowak from Pepper Hamilton, and see you next month.